Welcome back to our next lesson on depreciation. Okay, so we're talking about depreciation, and there's a nice cartoon for you. It's basically the idea that things go down in value over time, and it's how we quantify that in maths. So, as we're up to on our work rate calendar. So, what are we doing today? We're going to know the difference between straight line and reducing balance depreciation. We're going to understand what this depreciation formula means, calculate the depreciation of an asset, and basically see how depreciation formula is just a variation of compound interest. Alright, so depreciation is a reduction in value of an item as it ages over a period of time. So as an example there, we buy a car for $45,000, but a year later it's not worth $45,000 anymore. Even though that's what we paid, that's the amount of money we outlaid, it's not yet worth that anymore. So usually we look at depreciation as it changes over the course of a year, like on a yearly basis. All right, simple depreciation we want to start with is straight line depreciation. It's basically where we look at the same amount that we're reducing value in each year. So that car, for example, we would assume it goes down by the same amount each year. Typically with something like a car, we probably don't use straight line depreciation. It's more an item that may depreciate over a short period of time, like say a computer or something like that. So we've got a nice little formula here. So D with a little t down there, dt, is the depreciation over t years in dollars. It's the actual depreciation amount. And we say cumulative depreciation, as in you add up all the depreciation over a certain number of years. It's the total depreciation. We have the prime cost, which is kind of like the principal that we had before, and R is the rate of depreciation. So you can see it's kind of similar to our simple interest formula. We're just swapping these letters for new concepts, and whereas interest was typically an amount that was going up in value over time, depreciation is going down. So also we have the value. So where VT down the bottom here is the written down value. When something depreciates, we write down its value. That's what we say we do. Basically, it's the reduced amount that it's now worth. It's the depreciated amount. That car is not worth $45,000 anymore. A couple of years later, it might only be worth $30,000. That's its written down value. A computer, you might easily spend $1,000 on a brand new computer. In 3 years' time, you may have depreciated that item to the point where it's pretty much just a write-off in terms of value. Its written down value might end up being $50. All right, so basically the final value that we end up with is what we started with minus how much we depreciated, and that's reasonably straightforward. Okay, so let's have a look at these examples. Initial cost of a washing machine 2 years ago. So the time is now 2 years. The initial cost is like our principal, that's our prime cost, and it depreciates at 18.5% per annum. And we've got to find these two things, cumulative depreciation and the current written down value. So what do we do? Write down what we know. Once again, write down the values that we know. We know that the prime cost, which is like our principal, was $19.50. The rate that it's going down is 18.5%. Remember, 18.5 over 100, which is the same as that. We know that the time is 2 years because it told us in the question. All right, and it tells us in the question, calculate the cumulative depreciation. That's my formula here. So I know that that's the one I'm going to use. I've written down what I know, and then we substitute in. And notice that we have D2, which is like it was DT before, but we know that the time is 2 years, so we've written D2. It's just a slight variation. All right, substitute in your numbers, and the depreciation is $721.50. So if we subtract that from what we originally paid for this thing, $19.50, we'll get what it's worth now. So the value after 2 years is just subtract those two figures, $1,228.50 is what the machine's worth. Typically, we'd round that sort of number off in the real world. I mean, if you advertise this washing machine to sell it after a couple of years, you wouldn't sell it for $128.50. You'd obviously round that off. But in terms of accounting, like a company would account for the value of its equipment, that's probably the value they'd use. Okay, let's keep going. So, reducing balance straight line depreciation is this one here on the left. It's basically where we're reducing by a standard amount each year, much like simple interest goes up by the same amount of interest each year. All right, this one, it's reducing by the same amount each year. Reducing balance depreciation is a little bit different. It's a bit like the compound interest version, all right, where you're reducing by a percentage of what's left each year. So the amount that you reduce each year actually goes down, but over time it will still reduce in value. Think of this one on the left as simple interest, this one on the right, it's like compound interest, except both of them in reverse. We have our formula here. Now this formula should look reasonably similar to what we've seen before because it's just like the compound interest formula. The only difference is there's a minus sign in the middle here. It is exactly the same formula except it has that minus sign there. It's like when we were doing compound interest, it was a plus sign in there. We were adding on that interest rate each year. In this scenario, we're reducing by that interest rate each year. Okay, and that's what we mean down the bottom here. All right, so let's have a look at an example. So the prime cost of a lawnmower 7 years ago was $5,600. It depreciates at 9% per annum, assuming reducing balance depreciation. What's the current written down value of the mower? And what's the cumulative depreciation since we started? Okay. Think once again, what do I know? I know that it was 7 years, so I know my time is 7 years. The prime cost was $5,600. That's like my principal. And I've got an interest rate of 9%. Remember, write it as a decimal, or 0.09. All right. Now, that's what we've done in this line here. We wrote down all the values that we know. First thing you do is that. Second thing, write down the formula, which you get off the previous, the earlier slide. And then you substitute in what you know. Okay, now, the easy thing about depreciation is it's usually done annually. So your interest rate is always per year, and it starts off as per year. So you don't need to worry about the interest rate per compounding period or anything like that. It's slightly simpler in this scenario. And you know that the little indice up the top here, the little t, is time, and it's usually always done in years. So that's just the number of years from our question. All right, we plug it all into our formula, and $2,893.86 is what the lawnmower's worth. Must be a pretty good ride-on mower if we started off at over $5,000. All right, so second question, what is the cumulative depreciation over the course of this depreciating? What we've found when we use the formula up here is the value of the item after the 7 years. All right, so that's what the actual lawnmower's worth. So if we subtract our figures, so if we subtract this bloke away from what we started with, we're going to end up with what it's worth now. So that's what this means here. So the actual depreciation is our prime cost or principal minus the value that it's worth now, which is what we've done here. And $2,700 is what we lost in value. We lost $2,700 in value. And that's what this question means. Don't get confused. Question A says the current written down value, that's the formula. The cumulative depreciation means what did we actually lose? So the actual depreciation. Oops, I can't spell. So the depreciation. The actual amount that you lost. So let's just to summarize that. So straight line depreciation is depreciation at a percentage of its prime cost or initial value every year, whereas reducing balance depreciation, which is the formula, is depreciating at a percentage of its reduced value each year. Much like compound interest is interest as a percentage of what you've got, principal plus interest. This is kind of the same thing in reverse. All right, last thing we want to look at, unit cost depreciation. So the total depreciation of an item is its purchase cost minus any resale value, which is what we often refer to as scrap value. So that's the value that something has at the end of its useful life. So most businesses may, for example, say that a computer lasts 3 years, give or take. So they say at the end of the 3 years, there is some value left in that computer, but it's not what it started with. You spend $1,000 on that computer on day one. 3 years later, you write off that thing and say, no, it's not useful for us anymore, but you could still sell it. You could probably easily sell it for $50. So that's that its residual value or its resale value or its scrap value. You might buy a car for $50,000 and 2 or 3 years later it might be worth, say, $30,000. That's its scrap value or residual value, resale value, same sort of thing. That's what the thing's worth at the end of its useful life to you, that you could still sell it for. All right, the expected life of an item is basically a unit of time that you would expect that item to work. Okay, so for example, a computer, maybe it's 3 years. A car, a business might have that for say 2 or 3 years. All right, it depends on what it is, but maybe a really large, expensive imaging machine, for example, might easily have an expected life of say 20 years. It depends on the item. So what we look at is the unit cost depreciation. This is something businesses particularly get into. All right, so it's the dollars per unit of expected life. Now, if the expected life is measured in, say, the pages that a printer prints, right, how much does each of those pages cost you in its depreciation over its life? Okay, so what have we got here? A few little formulas. Total possible depreciation is what it costs you to start with minus what it's worth when you get rid of it. The unit cost depreciation is the total depreciation amount, which is what you worked out in that previous one, divided by its expected life. Okay, so it's basically working out a rate. Okay. This little formula down the bottom here is the same as this one here, but they're basically opposites of each other. They're very similar. Okay, let's have a look at how we actually use these formulae. Okay, so a laptop is expected to work for 6,000 hours before its resale or scrap value of $100. Its purchase price was $1,300. Okay, the laptop might work for 6,000 hours straight if it's running all the time, or it might last a lot longer if it's only running for a couple of hours here and there. So A, B, and C, and D, here's the things we've got to find out. We know that this is the life of the laptop. We know that its value at the end is going to be $100, and we know that it was worth this when we started. That's our prime cost or our principal. Okay, so first thing, we want to work out the total possible depreciation. Okay, total possible depreciation is our formula here. Prime cost minus scrap value. Cost $1,300 to start with. It's $100 worth $100 at the end, so it's pretty simple. Subtract the two, and that's the amount that you lost of value. That's the amount of depreciation. 1,300 minus 100. The total depreciation was $1,200. Okay, we're going to need that figure when we do the next one to find this unit cost. All right, so unit cost from our previous slide is this formula here. Total possible depreciation divided by the expected life. So if your total depreciation is $1,200, the expected life is 6,000 hours. 1,200 divided by 6,000 is 0.2. So what that means is that this is the 1,200 was in hours. So this figure's in, 1,200 was in dollars. So this figure is in dollars. so $0.2, which is the same as 20 cents. Okay, and our usage is done in hours, so it's 20 cents per hour of work is what the laptop actually costs, and we've got that as a nice little statement down the end there. Okay, so it's just a calculation. How much is my total depreciation over how many hours? Divide the two, and you get the amount per hour. So it's 20 cents per hour of work. Okay, so the depreciation after 1,000 hours of use. Now we know from the previous question up here that every hour costs 20 cents. So it should be a pretty easy calculation. If every hour is 20 cents, I want to know 1,000 hours. What's that work out to be? And that's what we've done here. Unit cost times the number of units done, 20 cents per hour, times the number of units done, 1,000. So 20 cents is $0.2, which we've done in this calculation down here. 0.2 times 1,000 is $200, is what 1,000 hours of work is going to cost in depreciation. All right, that's in value that you've lost of the item. All right, now the written down value after 1,000 hours of use. Well, from the previous question, we know that 1,000 hours of use costs $200. All right, we know we started at $1,300. So if we were at 1,300, we take away the 200, we get our answer. And that's what all this means. Prime cost minus the depreciation to that point, which is these two, which we've done there. $1,100 is what the laptop's worth after 1,000 hours of work. All right, have a think about what we've done today, because we've sort of covered a few different concepts. I just want you to keep in mind, you've got the straight line depreciation, which is a lot like your simple interest in reverse. The main formula that we'll use is the reducing one, which is just like the compound interest formula, but in reverse. And we had a few of those other calculations at the end there. All right, let's have a go at doing some of this work in the exercise. I do have a few more examples and stuff that follow this, follow these slides. If you want to get on with the work now, have a go. If you want to have a look at those examples, by all means, keep watching the video. Thanks a lot.